What up, HyperChange? Welcome to another episode. Today I'm doing a follow-up on Blink charging. Put out my original episode on the company a couple days ago after a user request from Pilgrim Proust. Shout out. Excellent comments, awesome discussion, learned a ton. The company reached out to me. In fact, I had a 25-minute call with the chairman, Michael Farkas. So I wanted to update you guys on my new thoughts on the company. And first of all, make a little bit of a correction because I was overly bearish on the company's geographic strategy of where they're placing their chargers. Although I was critical of the fact that they were choosing to locate their charging infrastructure in big cities because I thought the main use case for electric vehicle charging would be on a road trip because otherwise you're charging at home. This neglected a huge fact, which is the new wave of lower priced, lower income electric vehicle buyers are going to be heavily skewed towards these city urban apartment dwellers, and that's going to catapult the demand for these urban chargers just like the ones that Blink has installed, and therefore their geographic strategy I think is actually pretty smart. And if the company can hang around long enough to see this through, then in fact their network could one day be very, very profitable once EVs go mass market and mainstream. That being said, I'm still totally unconvinced on the company. If you take a look at these numbers, execution doesn't lie. The company has had a history of very large losses, not much revenue, and in fact, I've extrapolated their revenue from the first half of this year. This is just my guess. I think they're only going to do about $2.5 million in revenue this year, lose about $8 million. Their gross profit is minimal, so this is a company that's still incredibly struggling financially. Now, as I said last time, they only have about $500 in cash and over $20 million in debt. They are on the precipice of going bankrupt and being insolvent if they cannot raise capital. Therefore, the company about a month ago, and I didn't mention this in my last episode, but I'm getting into it now, getting our hands dirty. Before I get into this too much, I want to say I have a disclaimer in all my episodes in the bottom in the description. I'm not a financial advisor. I'm just a guy with an opinion who tries to tell you my ideas. This isn't a recommendation. I'm not compensated by any companies I cover. I don't own any stock in Blink. But yeah, so the point is the company has sort of a mini IPO document that is there for them to uplist to the NASDAQ and also raise about 20 to 25 million to keep its business going. Now in this filing, they're detailing all types of strategies, nuances, governance about the business, and I was doing a ton of research for this follow-up episode, and I came across all this juicy stuff that I want to show you. Let's just get right into it. What is Blink doing? They did a 1 to 50 stock split. So for every 50 shares you had, you get one. And the stock price in theory goes up 50x to make up for this. The reason they did this is to clean up their share structure. They had about 82 million shares outstanding pre-split. Now they have about 1.64 million shares outstanding post-split. So I was doing all my valuation work on the company based on their post-split 1.64 million shares. Then I'm reading this filing about them selling more stock. And remember, I put in the last episode, if they sell more stock, they're going to dilute. That share count of 1.64 million's got to go up. And guess what happens? One of the first things I read in this registration is,
we have a significant number of shares of our common stock issuable upon conversion of certain outstanding options, warrants, debt obligations, and convertible preferred stock, and the issuance of such shares upon exercise or conversion will have a dilutive impact on our stockholders. Sales of a substantial number of our shares of our common stock following this offering may adversely affect the market price of our common stock, and issuance of additional shares will dilute all other stockholders.
They're doing a ton of stuff to try and clean up their capital structure, but that could result in massive dilution. The company has Series A preferred stock, Series B preferred stock, Series C preferred stock that all their executives and insiders had, which is converting into common equity and going to dilute that 1.64 million share count dramatically, and they're telling you that right here in the filing. If we go down a little bit, you'll notice that a ton of these are mainly being issued to executives. And what I thought was fascinating is the founder of the company, it says here, has 3 million warrant shares owned by FGI, not subject to a reverse stock split at a weighted average price of 70 cents. FGI is an entity wholly owned by Michael Farkas. So everybody's stock gets split 1 for 50, except for 3 million shares that are owned by the founder, Michael Farkas. And remember, there's only 1.64 million shares outstanding, and this guy literally just has 3 more million shares that basically went from being 5% of the company to like 80% of the company overnight because of this 1 for 50 reverse stock split. And the warrant price of 70 cents stayed the same. So for you finance nerds out there, this was a company that was trading well below the strike price of 70 cents for his warrants. Now that they did the 1 for 50 reverse split, the stock price is trading at 15 bucks a share, well over 70 cents. His options are well in the money. I've never seen anything like this. At the end of it, it says, after the completion of this assumed public offering of $9.25 per share, there will be 9.9 million shares of our common stock outstanding. In addition, our articles of incorporation as amended permits the issuance of another 490 million shares upon the completion of this offering. And then it even says it would dilute the percentage of ownership held by investors who purchase shares in this common stock offering. So they're basically telling you that when this deal is all said and done, after they raise money, the share count's not going to be 1.64 million. It's going to be 9.97 million. This is huge. This means that my entire calculations about market cap and valuation were stratospherically off because I did not understand the magnitude of this company's dilution. That is all really sketchy to me, but okay. You can dilute what you want. The share count is what it is. They're paying executives. They're paying them a lot of stock. I think that's too much dilution, but it is what it is. Another interesting thing I thought to note was in the use of the proceeds. It says that there was a note issued to an entity controlled by Michael Farkas that is currently past due. The interest rate is 18%. So the company has a $540,000 loan that they took from the founder that he is charging 18%. I don't know. I loan money to HyperChange, the startup, and I do it at 0% interest because it's my startup and I want to benefit the company. It looks like this management team is lending money to its own company with an interest rate of 18%. That's astronomical. I don't know. That to me just seems weird and is a red flag. Additionally, if you look at what they're spending the money on, I was thinking like, okay, they only have 2.5 million revenue, 8 million in losses, or that's what I'm expecting them to do this year. They really need to cut expenses dramatically to have a chance at making this business go profitable. But if you look at the plans for what they plan to do with this, 18 to 20 million that they want to raise, 4 million of it is going directly into increasing the staff. 4 million of it's going to paying down debt. So what are we going to see happen? This cash is going to evaporate overnight. Now I'm even more skeptical because they're going to raise this cash, a big chunk of it, few million off the top is going to go to paying off debt. So the company's not even going to see that. Then you have more money going into hiring employees, which is only going to accelerate the burn rate. I think this company should put a freeze on hiring until they can grow revenue, not accentuate their burn rate. But that's exactly what they're going to do. So my guess is if they're hiring more people, ramping up expenses with this money, there's no way that this single raise is going to carry them to profitability. And my guess is they're going to have to do another raise, if not many more after this, to sustain the company. Moving on. Remember what I said before? This is just the same information, but summed up in a different part of the filing. Right now, they have 1.631 million shares outstanding. After the offering, they're going to have 9.970 million shares outstanding. So about 10 million shares outstanding after the offering. The stock's currently trading at $14.50 a share. That's $145 million market cap after this offering if it goes through, according to this 9.9 million share number. Guys, quickly, with $145 million market cap and 2.5 million in expected sales this year, we're looking at an average price sales ratio of 58 times price sales. And this is not a super high margin, super fast growing sales funnel. No, it's a revenue base that, according to my calculations, is declining. They're losing money on this revenue. The gross margins are super low. And you're paying 58 times for the price sales ratio if this offering goes through. So $145 million market cap for a company that I think is only doing 2.5 million in revenue this year is absurd. If I thought 9 times price sales was absurd, just don't even get me started on 58 times. That is what it is. I'll let you guys think that through. Continuing through the filing, I noticed that they said as of June 26th, they had 14,000 charging stations deployed. And they note that they have an early mover advantage and almost 100,000 drivers registered on their network, and this is one of their key competitive advantages. Well, I took a look at a company called ChargePoint, which has a very similar strategy. They're much more well capitalized. They're privately funded by some of Silicon Valley's top venture capital firms. They have over 40,000 total charging points, a way better website. From all that I can tell and understanding, ChargePoint has almost an identical business model to Car Charging Group or Blink Charging, but simply is way ahead of the game. They have tripled the installed charger base, 40,000 charging points versus 14,000 for Blink. We haven't hit that mass market electric vehicle, but when we do, the first mover with the best infrastructure is not Blink. Even if you're giving this business model the benefit of the doubt, even if you're saying urban charging is going to be huge, Blink isn't even the company that's best positioned to benefit from this. I would say ChargePoint is, and they're much more well capitalized. My guess is they're run much more efficiently. You're not even just competing with Tesla's supercharger network. Okay, this is what really rubs me the wrong way. Blink Charging only had $512,000 in gross profit last year. Remember that. But if you look at the employment agreement, they note that they gave a $60,000 signing bonus to Michael Farkas when they signed him in 2010. He started with a salary of $120,000, ramped up to $240,000, then $360,000, tripled in 3 years. As of 2014, they wanted to pay him a salary of $40,000 a month, increasing to $50,000 a month if he listed on a national exchange. And now, if you'll go towards what they're planning on paying him after the offering, they want to continue to pay him $30,000 a month of cash compensation. That's $360,000 a year. That's about 70% 18% of the entire company's gross profit is going directly to the CEO's salary. That is a huge red flag to me. And if you look at the other executives, all making over $200,000 of compensation, on top of getting commissions for running the company, the 3 executives alone are getting paid so much money that they're dwarfing the entire revenue and gross profit of this company. I want to see a management team that's incentivized for the stock to go up, not for them to just perpetuate their multi-$100,000 salary. And that's what I think is going on here. On top of that, part of the reason that Michael Farkas is getting so many shares on this offering is because he was funding the company himself with debt. And if you look at this debt, I almost want to call it toxic. He was charging an 18% interest rate on all these micro loans to the company, which were then giving him massive amounts of stock options, which he now has converted and is why he owns so much of the company. This just makes no sense to me. Why would you charge your own company an 18% interest rate and then give yourself more dilutive stock options? I don't know what to make of this, and I'm still actually, after you guys' comments and everything, very bullish on the overall business model of Blink and the fact that they're located with these chargers in cities. They could capitalize on the electric vehicle boom, but everything I've found about the company operationally just leaves me scratching my head. I think the executives are making way too much money for the stage of the company. If this capital raise goes through and the share count goes from 1.6 million to 9.9 million, you're going to see an incredible amount of dilution for current shareholders. The market cap is going to go to 150, 140 million, which puts the valuation so stratospherically beyond anything that I've ever seen that's rational that I just can't fathom who's giving the company money at this valuation with these terms. And remember, this is all my understanding. I'm not an expert. I want to open this up for you guys for questions. I could be totally reading this wrong, but my guess is if this new registration goes through, there's going to be huge dilution. So once again, I'm incredibly skeptical of Blink charging. I'd love to know what you guys think, but man, going through this, and I'm going to put the link. This is a public document, the registration filings. Like, if you're a Blink, you've got to read this. It's a massive document. I could have spent an hour going through all of the nuances of this thing. Opening up the floor to HyperChangers. Hope you guys liked the episode. I'll see you guys next time. That's HyperChange. Peace.